Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Cameron, welcome to the Australian Investors Podcast.
Hi, Owen. Great to be here.
Yeah, it's always good to chat. We spoke recently on the live mini-series that we did as part of Self-Wealth. It was heaps of fun, and we've spoken before about many different things as, your role kind of bridges ETFs, investment management, but also some of the major themes and trends we see in the market. And I want to spend a bit of time talking to you about fixed income. There are many reasons for that. It's probably been the number one topic for our community this year, particularly people later in life and who are seeking passive income. We did a survey recently, mate, and if you took passive income and you put it with retirement, that's what 9 out of 10 people are investing for, is for like either early retirement with passive income or on-time retirement with some passive income. So we're going to talk about that. We're going to talk about that yield focus. Speaking of, why do you think Australians have this love affair with income? It seems that way to me. Maybe I'm wrong, but why, if you agree, do you think that we seem to have that?
Yeah, it is interesting, and we're going to talk about fixed income here, which is what most of the world looks for when they think of income. Mm-hmm. But we're a bit different in Australia because we've got franking credits in our equity market, and that sort of created a little bit of a different picture here in Australia versus elsewhere. And clearly a lot of investors focus on franked dividends, and there's some good reasons for that focus. The imputation system, as it's called, which is what franking credits are generated under, is essentially built to ensure that corporate profits aren't taxed twice. So they're not taxed in the hands of the corporate and then in the hands of the shareholder. And that's different to other places like the US, where you do have sort of double taxation at those two levels. And it sort of meant that our markets have evolved a bit differently. If you look at US markets, the bond markets, in fact, dwarf the equity markets. Here, it's really the opposite. Our fixed income markets are relatively small in Australia. We have almost non-existent high yield market, for example. That's a very big part of capital markets in the States. So if you think about the opportunity set for what we have to invest in Australia, most people think first about investing in equities and think about generating income from equities, because getting franking credits means it's quite a tax efficient way of receiving income. I think it is interesting that the local tax legislation around franking credits has meant that if you look at the shares in our equity market, yes, we don't have as big a fixed income market, but our shares are somewhat more bond-like than the large US mega cap stocks, for example. We have banks and miners that pay out very large levels of distributions. They're somewhat incentivized because Australian investors are looking for that tax-effective income focus, and so in some senses, our equity markets, they're a little bit more bond-like. It's also the case that if you wanted to generate a return out of investing in Australian shares, so the ASX 200, I looked at this recently from the high point just before the GFC, which was about October 2007 until this month. If you didn't get any dividends on the ASX 200, you would be flat. And that's like about a 15, 16-year period. So income matters, dividends matter, and Australian investors, obviously see that as a big part of the return picture. We're conditioned that way. And so a good reason for the focus.
I know when we had Tom on the show recently, he talked about the R&D budgets that those mega caps have in the US versus, he was at the time talking about versus the industrialized S&P 500 type companies. It's really interesting, isn't it, when you think about the bond proxies? Like people have said for a long time, Telstra is a bond proxy. It's basically just consistent income, et cetera, but doesn't grow, And you think about the implications that maybe not just franking credits, like we're not here to beat up or otherwise on franking credits necessarily. But if you think about that, the incentive to not innovate is very, very attractive. And so for any investors that are looking at building a core portfolio, satellite allocation, you've got to consider that context. And I think particularly for folks that are, using ETFs as those building blocks, is making sure you're diversified just in case one of those things change. Maybe the tax regime changes, for example, and all of a sudden something else has to happen. One of the things that you said at the top there was that people typically globally, when they think about income, they think of fixed income, or they think of bonds. They think of government debt, they think of debt going to private companies, corporates, state governments, etc. But a lot of people in our community, Cam, they're looking at bond returns for last year, so 2022, and they're thinking to themselves, like I was just having this conversation with a retiree the other day who had a huge cash account, a huge term deposit allocation. And he was saying, like, I feel I shouldn't be in cash because inflation's beating my cash. But then I look at bonds in 2022, it was pretty horrible.
Absolutely.
But, yeah. So why, and then I'm getting this question like daily. Can you maybe reconcile that period, and then we'll maybe shift gaze to what happened this year in 2023?
Yeah. So the year that was 2022 was the worst year on record for fixed rate government bonds. So in the US or in Australia, the impact to the capital value of those bonds was horrendous. And the reasons for that are well known. But if you look at, say, Australian 10-year government bond, the yield on that at the start of the year was like about 1.7% at the start of 2022. And with expectations of future cash rates, skyrocketing versus what we'd seen historically, that meant that those the capital value of bonds had to adjust downwards to really accommodate that. Now, well, that's obviously not a great experience if you're holding bonds over that period. It wasn't something that most market participants forecast, that we'd see such a dramatic rise in cash rates in Australia, because I guess we've been somewhat conditioned. It is interesting, though, that once we see a higher yield environment, bonds become somewhat more protected. So the government bond yield here in Australia tipped over 4% for the 10-year government bond yield in about June last year. And what we've seen since then is that, that fixed rate bonds have continued to be a little bit volatile. But because they're earning a strong yield as a starting point, they're much better positioned to withstand that volatility. And generally, we've seen that most of our fixed rate bond funds from June last year have been positive in terms of their returns. And that's even when government bonds in Australia have gone up and tipped over 5% for periods. So that's quite encouraging now that we're really off the floor in terms of rates and yields, that we do have a more solid case for investing in fixed income. And I mean, we can talk about it, but also on a relative basis, fixed income, looks more attractive versus the yields that we can see in a lot of the equity market.
Yeah, because that's the thing, right? We were speaking to financial advisors late last year in 2022, and they were saying, this is where we're going. We're not going all or nothing. Like, it's not all floating rates or all fixed rates, but we're moving into fixed rates because, yeah, sure, there might be some pain in early 2023, but we're going to move there and get positioned for that. And one of the things Tom did say was that now you can do that with ETFs, which is, from the last time yields were 5% on Aussie bonds is, there was none. So all of a sudden ETFs, as we know, are the premier investment vehicle for building portfolios. And now there's a whole suite of funds for people to invest in that, and the yields are there. Can you maybe just talk us through that, actually, that kind of like transition we've had this year for the ETF market, like how that has changed as well, like from a big picture, what we've seen?
Yeah. So I think, there's a couple of factors here, but it is interesting. If you look at the ETF ecosystem, the use case for ETFs, maybe if you go back 10 years, was to get my global equities exposure, because that was hard to access. So I might buy my own shares. I'd probably buy Telstra, the big banks, a couple of miners, Woolies, and then I'd go offshore and get an ETF for that, offshore exposure. Fixed income has been an asset class where ETFs haven't really had a foothold until really the last 5 years. And that was partly because there wasn't a great deal of choice. But there's also some other factors in there. In a low return asset class, so fixed income, you expect over the journey to have lower returns than equities. We should also think about, the Australian consumer. They're not just, buying a bond in a frictionless market. So they're basically either going through, for example, a financial advisor, and they're holding those investments on an investment or a wrap platform, and there will be administration fees that are attached to that. So that's already a bit of a hurdle for me holding fixed income if my return expectations are lower than equities. And also we've got in the ETF landscape, there is brokerage associated with transacting any on-market security. So again, another hurdle. But the good thing is we're seeing prices become more competitive in both of those environments. So, for example, platforms are now offering lower cost solutions for clients, and also even if we look at the direct trading on the ASX, we're seeing the rise of very low and in fact indeed zero brokerage models for people who want to buy ETFs. So Betashares Direct, you may know on. Yep. We've launched Betashares Direct, just recently. Very excited by this initiative, and it allows investors to invest across any ETF, not just Betashares ETFs, on the ASX with zero brokerage. And so for a lower return asset class like fixed income, taking away those frictions is really important. It's really important to do so, to be able to buy any sort of fixed income or cash solution on the ASX when it's going to be very low management fees to begin with, just much better outcomes. So these are some of the factors that are making it easier for people to be invested in fixed income. But a lot of it is also that market shift, as we talked about. The higher yield environment has meant that people can reevaluate what they're doing in fixed income, how they're using fixed income as an asset class, and really the opportunity to generate returns in that asset class. And part of the really positive story is there are a lot of investors who aren't necessarily ready to add, say, fixed rate bonds into their portfolio, because fixed rate bonds will be subject to more of that volatility from government bond yields going up and down. However, there are a range of ETFs that provide exposure to floating rate or variable rate, fixed income securities, which then increase in line with changes in effectively the cash rate, to provide a more capital stable investment. But you're also benefiting from that higher yield environment. So the solutions across that fixed income spectrum and the growth in ETFs really allows people to be, quite thoughtful in how they access the asset class.
It's incredible to think about the frictional costs of previous things and how things have dramatically evolved. Obviously, talking about Betashares Direct there as well, like the barriers have come instantly down basically, and the ability to just without friction move into a diversified portfolio is something that like 10 years ago you said like it was even just hard to invest in US shares or global shares, and now you can in a matter of minutes you can be exposed potentially. So there was another question that I had here for you, which was something that I deal with a lot, and I'm just curious to hear how you think about this, which is a lot of people, because of the conversation we just had about income and growth and these types of things, a lot of people think, well, hey, I'm a high risk investor. I know a bit about investing, and these are people with big portfolios, Cam, like millions of dollars and whatever. They're like, well, hey, I've got this. I think the Morgan Housel line was, everyone's a high growth investor until the next market crash.
But, that's a great line.
But that said, a lot of them think, well, hey, I don't need the bonds because I've still got 20 years till I retire. I want to compound as much as possible. How do you think about that? Like, how do you think about the role bonds might have in more accumulation mode? Do they have a role? How do you think that fares?
Yeah, that's I guess when we think about investing, someone who's a young accumulator, and this is obviously very dependent on the individual's risk tolerance and their circumstances, but typically speaking, young accumulators are more likely to have a higher risk tolerance. And there are some good reasons for that. Firstly, your original capital that you hold is not as large as hopefully it is at the end of your investing journey. So you've got less to lose, and you've also got an income. Your salary is going to make up for hopefully any dips that you see in markets throughout the journey. And so, from a purely, mathematical standpoint, if equities have a higher expected return than bonds, then I should allocate more of my capital to equities. There is a lot to investing, which involves psychology and emotions, and investor behavior. In some cases, is a terrible thing. And I think the point you made about everyone thinks they should be 100% equities until they see a significant market crash. And it's probably, if you look at where we've been in markets for the last sort of 23 years, we saw a reasonably material and elongated sell-off in the .com crash. So US equities are down about 50%. In the GFC, Australian and US equities are down about 50%. Now, those two sell-offs were really something that occurred over, really a couple of years. The bear markets were pretty significant. Since that point, we haven't seen any kind of, long-term, drawdown in equities. We obviously had the COVID crash. We had some sell-off in 2018, which was quite short-dated and obviously much more shallow. So that the point about, not wanting to allocate to defensive assets, I think, does get tested when markets get tougher. I mean, seeing your portfolio down 50%, if you did allocate all to equities in a 50% sell-off, that's a tough thing to bear. And we do see that often while people might say they're 100%, equities, that they'll then pull money out of the market and just put it in cash, often not take advantage of fixed income, which might actually appreciate in a recession led sell-off. So look, but even investor truly does have risk tolerance for 100% equities. There's absolutely there's great solutions. You can obviously build your own diversified portfolio, and I think diversification, if you are going to be 100% allocated to equities, is really the key. I mean, you have to have some form of risk mitigation, and diversification is an excellent tool. We have, for example, DHHF, which is our Betashares All Growth ETF, which is giving you exposure to a globally diversified portfolio of Australian and global equities and rebalance. And it comes at a very low management fee of 0.19%. So that's a great way to get that all growth exposure and allow you to just continually invest part of your paycheck every month. So you can have a solution like that. But if you are somewhat more risk averse than having 100% allocation, then the great thing about fixed rate bonds in particular is when equities tend to sell off because earnings start falling, which is typically associated with a recession, that's when we tend to see that, and I'll get a bit technical here, but forward expectations of cash rates come down and therefore bond yields come down. So bond yields are a reflection of a few things, but broadly economic growth and expectations for cash rates. So when you have that recession and your equities fall, ideally that's the point in time when your bonds are rising in value. And when that happens, you get that offset. And obviously if you are then rebalancing your portfolio, you tend to sell the expensive thing and buy more of the cheap thing, which is great if you see a recovery in equities from that point.
And that's the thing, I think, and well said there, I think that's the thing with the opportunity set right now is people don't have to give up potentially like growth because they're getting an asset, which is fixed income in this case. They're getting an asset class that is paying respectable income. It's probably priced more effectively than ever. And that the idea of that happening is all of a sudden a reality again. But when rates obviously like close to zero, it's a bit of a different equation for folks.
Yeah.
So people that struggle to think about what goes into that side of a portfolio, I wanted to give you a bit of a hypothetical, a strictly hypothetical. Everyone can go and speak to their financial advisor, of course, and read the product disclosure statement and target market determination of any fund or ETF that we might talk about. But I want you to imagine that an investor wanted to allocate, say, 30% of his or her portfolio to fixed income, because this is just a general rule that I've seemed to have come across, is that in Australia, people tend to allocate on average slightly less. I could be wrong about this, is more anecdotally, on average slightly less because of all the reasons we talked about earlier. How could they think about what would go into that 30%? So building blocks, and feel free to mention Betashares products. Like it's no sweat. Like people want to know what is available in the market. So go for it. Like tell us what would probably be the building blocks in there.
Yeah, okay. Maybe I'll talk about fixed income in terms of, broad types of fixed income funds that you can get.
Sure.
And probably, we started off talking a bit about income. Now, this obviously, as you sort of mentioned, is hypothetical, and it all depends on your personal circumstances. But one of those personal circumstances might be, do you have a requirement for a certain amount of income? Like, do you need to earn, say, 4 or 5% out of your overall portfolio? So I think the first thing that we tend to look at when we're building a portfolio is we look at the equity side of our portfolio, because that's, going to be the majority of your portfolio in the 70-30 split. And that's really going to drive the majority of your overall returns. It'll be more volatile than the fixed income portfolio or the defensive part of your portfolio. So that's the first thing, is you're taking care of that equity side of things. So now you've got to think, well, if I do indeed have a yield target or a cash flow requirement, then what can I put in that fixed income part of my portfolio to meet that? And where I have met that, or where if I don't have that, what can I do to provide some sort of risk diversification for my equities? So there's a few things there. And I mean, maybe on that income point, the great thing, and you mentioned this, is if I look across, for example, our Betashares fixed income funds, we've got, AAA, which is cash, cash held in bank accounts, and that's earning just more than the RBA cash rate. But our other fixed income funds are generally all earning, have a yield to maturity, as it's called, or a all-in yield of greater than 5%. So you're in a great starting point. But to break up and talk more generally about fixed income, we would categorize fixed income, which is a bit of a tricky sort of asset class because a lot of technical terms, as four sort of pillars of fixed income. The first being cash or cash-like exposures. So I mentioned AAA, so it's cash held. It's an ETF that holds cash in 7 or 8 bank accounts. But you could think of your cash in your own personal bank account as the same. A term deposit might be in that book, or indeed a money market fund might be in that book. So we're launching tomorrow MMKT, which is a money market fund. It's giving you very much a cash-like return, a little bit higher than cash with a tiny little bit more risk. But that's your sort of cash bucket. And then we sort of move up in a couple of different directions. The next pillar, as I'd call it, so that's cash. The next pillar is what I call credit income. These are funds that typically have very small or zero exposure to fixed rate bond movements, so changes in bond yields driven by changes in monetary policy, but harvest credit premia, or indeed take on a degree of credit risk to give you a income return greater than cash. And this can be a really useful tool for building higher level of income in your portfolio, or indeed if you have a slightly higher risk tolerance. So you may not want to allocate everything to equities, but you might be comfortable having some fixed income, which is a slightly higher degree of risk, if you like. And credit risk is obviously, it's if you like a type of risk to corporates, a little bit different to equity risk, lower risk, but it's there, and you can earn more. So, for example, if we look at our hybrids funds, we've got HBRD or Beehive that. Beehive, I think, has a current all-in yield of a little bit more than 7%, including franking credits. So you can see how you can generate additional income there, indeed from hybrids, or you might choose a fund which is a little bit higher in terms of credit quality, but still earning more than cash. So Coupon, which is our senior floating rate note bank ETF, earning more than cash and TD. So that's all within the credit income space, variable exposure. So you'll see quite good capital stability when government bonds move, but you're earning a little bit more return. And then, so we move on there to what we call traditional fixed rate bond funds. So these are funds that will have, fixed coupons, bonds with fixed coupons. They might be government bonds, they might be corporate bonds, they might be state government bonds, or issued by what are called supranational agencies that are backed by governments. And the role there is predominantly about getting exposure to the what's called duration, or getting exposure to fixed rate bonds. And the benefit of that can be, as I mentioned before, when equities earnings tends to fall and you see a recession, central banks will tend to pivot to cutting rates, and then government bond yields fall, and the capital value of a fixed rate bond fund, all else equal, and depends exactly what securities are in there, you should expect an offset there or a rise. That's a defensive tool to use in your portfolio. And then the final pillar, which is a little bit more new to Australian investors, is inflation-linked securities. So, there is another potential economic scenario where we see anemic growth, but we see a higher level of inflation. And so an inflation-linked exposure may protect you from a higher level of structural long-term inflation. So we have a fund called UTIP, which is US Treasury, so government bonds, which are inflation-linked. So that's another thing that you can build into your portfolio. For most investors, if I'm thinking about that 70-30 split, most investors will probably choose an allocation to either cash or credit income space. So it might be, say, for example, AAA, or for example, coupon, or another fund from another provider. And then they'll also, because they do have that 70% allocation to equities, have some of that traditional fixed rate bond exposure to provide you that offset when things really get tough in equity markets.
Yeah, and just want to confirm for folks that are listening, coupon is QPON, not coupon as if it's spelt like you're looking at a bond, but it's a play on that, so QPON. Yeah,
I should spell it out, shouldn't I?
No, but all the information is available on the Betashares website. But that's actually a really good, it's probably the best primer we've had on the show, Cam, for how those kind of like pillars fit into that one big bucket. And it's a really good way of showing how you can move up the risk spectrum, or, even though they're government bonds, they're fixed rates, so they do have variability. It shows people how you can kind of put them together. And I'd say in our community, what we've seen over this year in 2023 is a mix of more people slowly moving back towards the fixed income, towards that kind of fixed rate bond. Not entirely there yet, but just kind of stepping sideways into that. And I think that was a great summary that you gave us there. So there's two more things that I would like to talk about, two big pillars. One is, I think it was you that recently penned an article on the Betashares website. You can just head to Betashares Insights tab there in the menu. But I think you talked about like the outlook for dividends within the kind of broad remit of the ASX, because I didn't know this, but you did this chart, which was really kind of cool. It looked kind of like a yield curve, if any finance nerds like us out there. But it actually showed the composition of dividend payments. And basically what I'm saying is it showed where the money actually comes from if you invest in like the A200 ETF and you just get a distribution, where that money actually comes from. And a lot of it comes from BHP, from Rio Tinto, from CBA, these types of companies. And some of those companies have actually cut their dividends. So I guess my kind of just general thinking is, like, as a jumping off point, is like, how do people think about that as a picture overall? Like, how can you rely on that? Like, what are the implications of that? Can you just talk through that a little bit?
Yeah, of course. I think the chart's, well, I call it a waterfall chart, but it might actually be called something else. But I quite like that chart. So essentially, you can look at the overall yield from the ASX 200 based off its component parts, and starting with the largest contributor, which I believe was BHP in the chart. If you build up the overall yield of the ASX 200, you can see that a remarkably high share of the overall market yield comes from, I think it was the top 10 companies account for about 60% of the overall market yield. And so, I guess the danger there, which I think I discussed in the insights piece, is that the concentration of that yield really does sit in large cap materials companies. You know the names. In also Woodside has been a large contributor, and our big four banks. And so they are what you would describe as cyclical sectors. We know that we've had a bit of a bull run in, for example, in iron ore price, and almost surprisingly, the iron ore price is still well above $100, which we'll wait to see what happens with Chinese demand and their property sector. Our banks have somewhat recovered off the back of COVID, and so they're really underwriting the overall ASX 200 yield. And look, I mean, that's great. They've had a really strong history of being able to maintain dividends, and the ASX 200 yield has generally been pretty well maintained. But there has been periods of time when, for example, banks' dividends have fallen at the same time that the miners' dividends have actually increased. And we saw that just subsequent to COVID, where one is filling in the whole of the other. So we've been quite lucky. I guess the risk is if both were to see cuts to dividends, then that starts to erode the income you can get from the equity side of your portfolio. And I was just really making sure that I wanted to let people know about this sort of risk and, think about this if they're in fact depending on equities for yield, because of course fixed income, a fixed rate bond, there's a contractual right for income there, whereas dividends are subject to the fortunes of the company and the dividend policies of management. With regard to the overall outlook, no question there is obviously risk around the profits from miners, depending on largely the iron ore price, but also in the case of Woodside on energy prices. But the other one that is sort of interesting are the banks, and some potential changes coming to their requirements for how they raise capital, which are a bit technical, but may result in them needing to issue a little bit more equity and thereby diluting shareholders and potentially eroding some of their earnings and therefore dividends. And, depending on the economic scenario, we might see them needing to have higher, bad and doubtful debts, so higher provisions against their loan book. So without wanting to sound like, Chicken Little, there's risks there. You've got to think about that. I just think, be mindful of this fact and be grateful for the income that we've seen from our market, but don't take it for granted.
Yeah, that's a really good point. You guys do have, most of you guys, Betashares have a range of products that take a different approach rather than just market beta.
Yeah.
And we do get a lot of questions about them. So maybe if you just, in the interest of time, maybe you just want to pick one, Cameron, and just tell us kind of what it does. And the literature is available on the website, but tell us how it kind of deals with different ranges of outcomes, I guess.
Yeah. So really briefly, there's two general approaches if you want to generate additional income over and above the overall market income. One is to skew your portfolio to the more high dividend paying stocks. That's a popular approach. We that does sometimes introduce quite a lot of sector concentration, and you can be subject to dividend traps and alike. We have a fund that isn't exactly in that vein, but our QOZ or our Australian FTSE RAFI Australia 200 ETF invests in the 200 largest companies based off a number of criteria, including sales, overall valuations, cash flows, and dividends. And that gives you a slightly higher allocation or a slightly higher yield than the broader market. But I think one that is perhaps quite relevant in this discussion would be YMAX. YMAX, I'll spell it out. And this is so the approach of YMAX is what's known as a covered call strategy. In this, what you do is you hold the underlying shares, and we do this. We passively hold the 20 largest stocks on the ASX, and then what we do is we write call options, which have a strike price slightly above the current market stock price, and generate income from writing those call options. Now, what you give away there is you give away some potential upside if those shares appreciate in value greater than that strike price, because there's a trade-off there. But we're finding that a lot of investors are sort of seeing the overall index level hasn't really appreciated much in the last 2 years, and indeed the performance of a fund like YMAX, because it's getting this additional income and giving away upside, which really we haven't seen any upside, has played quite well. But I guess more importantly for an income-focused investor, the additional income over the last year, over and above the ASX, has been an additional 4% in income from this, writing these call options. So that's a really good outcome, because it's also a more consistent form of income versus dividends if dividends become threatened. So what we've seen is that YMAX over time, and obviously past performance isn't a guarantee of future performance, but over time we've seen that YMAX has been a very consistent payer of income and a much higher payer of income than the broad market.
I didn't know it was that high. That's really interesting. I've got two more tongue-in-cheek style questions to ask you at the end, which are the same ones I asked Tom a little while ago. But one of the things that's just I know you're thinking about, because this is like what you think about in your role. But as we approach 2024, people are thinking, well, what are the things that kind of matter? Like everyone, probably falls into the trap of trying to, forecast markets and all that sort of stuff, which is probably outside my skill set. But I guess maybe if we could just give some people things to watch, like what you're watching as a high level. Like if we started the show by saying back in 2022 it was a bad year, if only we could have seen this coming kind of thing. And some people, were aware of what was happening. It was fair to say. So at that time now in the following year, and we look ahead to 2024, what are the things that you are watching, generally speaking?
Yeah. So one thing that just looking at just this week really is, what people sort of refer to as US exceptionalism, and how that might play out in terms of the US equity market. If we look at economic data, US GDP is absolutely surprised on the upside this year. Their economy has just proven to be incredibly resilient. Their GDP is growing by just under 5%. So they are, absolutely an incredible, very dynamic economy. And, a part of this is due to a very large amount of fiscal stimulus. And that's obviously, got risks around the amount of debt that needs to be issued by Treasury. But, if we look at how that's playing through to equities, if we're investing in US equities, the projections for earnings growth in the US next year are, in fact, incredibly strong, and the year after. And there's good reason to be confident, particularly sectors of the market that have tailwinds are going to meet those expectations. Now, when we talk about equity market valuations, we talk about price to earnings ratios typically. The way that someone talks about a price to earnings ratio is typically to look at the earnings over the next 12 months relative to the current price. Because those earnings are growing more strongly, we're seeing that the price to earnings ratios are in fact falling. And the market doesn't need to, move down for us to see that those price to earnings ratios could indeed fall further into the future. Because if we go forward another 6 months, those forward earnings expectations, if nothing else changes in them, will be higher still. And so, when we've heard a lot of conversation about the US equity market being expensive, and it has been over the last year, the current price to earnings ratio, now the S&P is around about 17, which is a bit on the high side. But if we take out, those very large tech stocks, we can look at, for example, the US S&P 500 equal weight, which is arguably a broader representation of US equities. The price to earnings ratio there is about 14, which is kind of just under long-term average. So, a lot of the US equity market actually doesn't look overly expensive. We've got strong earnings momentum there, and their economy is going gangbusters. So that's certainly one thing that I think is, very interesting. And perhaps we need to reset our expectations. And there's been a lot of doom and gloom about, the recession, that if we look at underlying fundamentals, the picture perhaps looks a bit brighter than what a lot of people were talking about 6 months ago.
It gives people a lot of that idea. And I remember every time I look at, because if you go to, I know I plugged the Betashares website a fair bit, but if you actually go to the fact sheet for NDQ, it shows I think it's the next 12 months price earnings ratio or something like this. And it actually shows you, every time I look at it, and I'm like, it's not as high as I thought.
It's
and
then you two at the moment. Yeah.
And then you look at S&P 500, you're like, it's not as high as I thought. And because they perform so well, you just think it should be higher, but it's because they're growing so fast they can support it. And that's that US exceptionalism. Actually, I've actually got to talk about this later today, and I've got that chart. I'm like, this is the thing.
Right.
Okay, so I've got final questions for you, and these can be quite polarizing. But I think I'm led to believe you may even have a prop for people that are watching the video version of this podcast, mate. But what do you think is the most overrated finance book?
Okay, so full disclaimer, Owen, you told me you were going to ask this question in advance, so I had full warning. You might be able to see just off to the side there's a bookshelf. So we've got a whole bunch of finance books. I will just disclaim that I typically don't read, how-to finance books. I feel like I get enough of that in my day job. But I am a avid reader of books about certain events in finance, historical events, and things that have happened. So one of my favorite authors is Michael Lewis. But I will say, I've read a lot of his books. So I've got here The Big Short. I recommend that one. Even if you've seen the film, I recommend reading that. This is another really good one. Roger Lowenstein, When Genius Failed. That's about long-term capital management. But one that I'm actually I found really underwhelming and disappointing was Flash Boys, which is a Michael Lewis book. It just had a couple of interesting anecdotes, but I thought it was just a bit weak as a story, and my expectations for him as a writer are just so high that wasn't my favorite.
It's like when you meet a celebrity, maybe you just like, oh, that's it. Well, I'd like to thank Cameron from Betashares for coming on the Australian Investors podcast and sharing all of his wisdom with us. To learn more about Betashares and to hear more from Cameron Gleeson, you can head to the Betashares website to discover their range of ETFs and all of the other interesting insights that they bring. I'm Owen Raskovich. Bye for now.